Test. 1 million, 2 million, 3 million. Okay. This was a joke that Warren Buffett did at the AGM when he came up to the microphone. He said, test, and he said, instead of 1, 2, 3, he said 1 million, 2 million, 3 million. Nobody laughed when I did the joke. When he did the joke, everyone was laughing, obviously, because probably the smallest currency he knows is 1 million, 2 million, 3 million. So given I just tested the microphone, I wanted to start with the same joke. So my name is Muhammed. I just moved to Dubai a year ago. I'm a friend of Beko, friend of the firm, and I'm delighted to be here on stage with my distinguished guests. What we will be talking about is, as the title says, whether it's now time for institutions to arrive in this new emerging asset class, or whether actually, this asset class, as always, people try to ask themselves whether this was a fad. And every time, especially now, when prices fall, people get worried about whether they got totally overexcited with this asset class. Now, what I want to do is, I want to start quickly with my personal story, and I would like each panelist to do the same. My background is finance. I was living 15 years in London, working for hedge funds. So I'm an equity long-short fund manager. And in 2015, by a friend of mine, I got interested in blockchain. Late 2015, back then, in the summer, from the summer to late 2015, back then it was extremely difficult to find information on this industry. You were basically forced to watch videos of 15-year-olds in their parents' backyard, basically, trying to explain to you this new technology. And by the end of late 2015, I decided to get involved and test it out. So I bought a bit of Bitcoin, and I was mostly intrigued by the ability that you can send money from A to B, and basically the solving of the double spend problem, so to say. I can explain that, but basically I was very intrigued about that because I was thinking, how can you send money from A to B without using the SWIFT system, the banking system? So I thought I'll try it out. So what I did is I asked 6 of my friends. I was living in London. I had a friend in Istanbul, another friend in Dubai, a Turkish friend of mine in Iran, and a German guy in Japan, and my brother in Frankfurt. And on a Sunday, we moved a few $100,000 of Bitcoin from London to Turkey, from Turkey to Dubai, from Dubai to Japan, from Japan to Frankfurt, and then back to London. The reason why I chose the Sunday is because most banks, except for this region, are closed on Sundays. So I wanted to see if it's if it's all going to work, basically. And secondly, I chose a Sunday because I thought, not only are banks closed, but most other businesses are not there. So, it's a good day, basically, to challenge this new technology. So what happened is, in approximately less than 10 hours, the money came back to me, so I could trust my friends. They actually did send it on. The money came back to me, and the whole transaction back then cost us less than $50. So if you can imagine, you're spending $100,000+ across the globe, touching Iran, and it's actually costs you less than $50. That, in my mind, back then, was 1,000 times improvement to what I knew of, basically in terms of the day-to-day use. And any one of you guys who are doing international business, international transfers, or even have family and friends in other countries, you will know of the charges as well as the time that it takes to send money across borders, basically. For me, that was the reason. That was my personal story of why I thought, look, if this is immutable and at the same time is actually limited in numbers and it has this type of advantage, then this could be something, basically, right? So that's when I got involved. And I wanted to share that because I think it's very important, especially for investors and events like this, for everybody to try it out. Like I would say the best thing, for example, on the bus panel that we had, I would say LPs should go to Cairo and try it out. That's the best way to experience something and to basically see if you think that product is viable. Because if it works for you, it probably works for others as well. So I wanted to start with that, and I'm going to hand over to Jez, and please introduce yourself in terms of more detail, and also give your personal story.
I'm Mohideen. I am the Chief Digital Officer for Nomura globally. Primarily, my focus is on digital asset. Particularly, I've led an effort on custody, and also into AI and machine learning application, particularly into trading. That's my background as well. Also looking at any fintech, particularly disruption within and outside investment as well as partnerships. So kind of all kind of exciting opportunity, more trying to take the investment bank into a digital era. That's a heavy focus of mine at the moment. My background actually, in terms of when it comes to digital asset per se, started my career in tech and AI about 20 years ago, and worked in many financial institutions, and lastly when I was at a hedge fund, particularly around the time of 2012-13, when Europe was going through a debt crisis. While I was trading, one of the things I noticed was, a lot of the asset, like historically, gold was the best hedge for safe haven, and you saw a lot of, time people went after gold. Particularly, it's a serious debt crisis Europe faced when the spreads were blowing out. Just before Draghi came out with his, obviously the largest optionality in the market, when he said, whatever it takes. Prior to that, obviously, when the market was blowing out, people looking at different hedging options. One of the things I started to notice was the inception at least at that time, the financial institutes started looking at the movement of Bitcoin, and particularly, could it be a hedge? And there's a lot of talk in the financial community, trading community, and a lot of people are doing in the private trading, because it was not available for financial institutions to use per se. But you could see the correlation it had versus the debt during the debt crisis. It probably was the best hedge, as opposed to gold historically being, or other hedges that worked out. So, of course, that was the inception, and during that period kind of got heavily involved in it to understand, particularly with the debt crisis what the world was facing, monetary debasement, QE, worry about holding cash. So we got heavily into it, and that's what kind of got me going and started trading it. And part of the hedge fund, even we looked at launching the fund, and now post that I've moved into obviously a financial institution again. Here the focus, heavy focus, is when it comes to digital asset is, I'm a strong believer, without truly institutional custody, very difficult institutions to adapt as a, or use this as asset class. So heavy focus has been on that.
Maybe the one takeaway that I have from what you said, Jez, is that it's quite interesting that this is probably in what we would know as the financial history, the first innovation that started from retail and is being adopted by institutional, whereas every other financial product actually goes the other way around, right? It starts on institutional level and then at the end gets sold to the retail.
That's right. Even at institutional level, what I've noticed is, just not necessarily financial institutions, across the institutions, they've started, when this asset came about, it's gone from a fraud initially. At the inception, everybody thought it was a fraud, trying to obviously game the tax systems and the governments through the decentralization. Then it's gone to the next phase, which is obviously kind of denial that it's going to. And now, actually, recently, particularly over the last, I would say, 6 to 8 months after this big crash in the crypto you had towards early this year, when the retail got excited about it, the institutions that I've looked at it, they're starting to adapt, or they're starting to accept this is here to stay type of thing. So,
interesting. Please, Ben.
So, thanks for having me here. My name is Ben Savage. I manage a financial technology venture capital fund in Los Angeles called Clocktower Ventures. And so my interest in cryptocurrency and digital assets is as much professional as it is personal, in the sense that clearly the future of financial services, at least may involve crypto and blockchain. But our platform, we also manage a hedge fund seeding business and have a lot of connectivity in the global macro hedge fund space in particular. And so we've actually been talking about crypto for 3 years, at least in part because everyone we know in the hedge fund world finds crypto really fascinating. And over the past few years, what we've witnessed is just a tremendous amount of interest from hedge fund managers, and a lot of our limited partners are chief investment officers of hedge funds in crypto and digital currencies, even though there's a fairly wide gap between their level of interest and their level of understanding of these technologies. And so we've taken a particular interest in trying to understand the future of the hedge fund industry as it relates to crypto, and I sit on the board of a organization called Medici, which hosts really the largest event in the world on crypto asset managers, in particular third-party hedge funds that manage crypto hedge funds. And I think what we would say about where the kind of current state of the world is with respect to institutions managing crypto, I agree with Jez very much that custody is a problem that needs to be solved. But this is still an incredibly small thing. The aggregate AUM, as best we can get to, of third-party managers that run crypto assets today is somewhere between $3 and $4 billion, which there are individual venture capital funds that are bigger than that at this point. And certainly relative to the aggregate size of the hedge fund industry, which is several $1 trillion, this is an incredibly tiny asset class. Now, the retail trading is quite large, and there's a lot of institutions that trade their own balance sheet in crypto, but actually third-party managed assets is vanishingly small. It was probably 3 to 5 times that number a year ago. The sort of fall in the asset itself tells you something, and it tells you that the hedge fund strategies to date are largely just tracking the beta of the underlying currencies. But we think that there will, over time, be a continued growth in this kind of institutional managed funds, and it's an area that we're paying a lot of attention to.
That's very interesting. Actually, yesterday, I met a gentleman from New Zealand, and he didn't know anything about Bitcoin or blockchain. And then we got talking a bit. And I tried to explain to him, I said, look, it's basically a protocol. Think of it like FIFA rules. And you'll have 21 million coins, and the protocol is limited to 21 million coins. And, and every 10.5 minutes, a block gets mined. And the rewards get distributed, and that's how the number of coins in circulation rise. But it will never be more than 21 million, and we will reach there. By 2040, 99.9% of coins will be done, but by 2140, so in 20 years, basically 99% of bitcoins will be mined already. But in 120 years, there'll basically be no more bitcoins to be mined, because obviously, as you guys know, it's a curve that becomes less and less over time. So when I said that to him, he stepped back a bit and he said, wait a sec, so you're telling me that from 20 years onwards, if it doesn't come into significant in existence anymore, for someone to buy it, he needs to pay a higher price than someone else, because otherwise, why would the other guy sell it, basically? If it's a completely finite, limited commodity, then, So what I was trying to say is, exactly like you mentioned on the hedge fund world, it's no wonder that, financial market participants get interested in this kind of things, because they immediately think of the trading aspect of it, the resale value of it, etc. And obviously, like you mentioned, Jez, coming from the gold side and knowing, having gone financial crises, and then knowing that that's the ultimate true hedge that you have in your portfolio, basically, when things go really bad, and their supply is still increasing, basically, right? So it's kind of normal that hedge fund guys find this kind of things then really, really attractive. I want to go over to Carlos. If you can please introduce yourself and
Sure.
Tell us your personal story.
Thanks for having me here. My name is Carlos Domingo. My career has had like 3 different periods. The first 10 years, I was in the dot-com space during the 90s, and I saw the rise and the fall, and then all the value that was created afterwards. The next 10 years, I was in the telco industry. I started in 2006, just the year before the iPhone came out. So I saw also the growth of mobile, and then, the decline, especially of the telco industry. And the last, and, now I'm very much into purely blockchain and crypto. I'll tell you in a minute what I do, but, to tell the story how I got there, I just moved out of Dubai. I was living here for 4 years. I moved back to the US this summer. And when I was in Dubai, I got involved with the blockchain project that the Dubai government was doing. In 2016, they created something called the Global Blockchain Council to explore the possibilities of using blockchain to basically secure the transactions of the government across multiple agencies, right? So as you said at the beginning, the beauty of Bitcoin is it allows you to transfer value from one person to another over the internet without an intermediary, right? And then you can generalize this and apply it to many other places where multiple people need to move value from one to other without trusting each other, and we have one person in the middle guaranteeing that the transaction happens. So last year, when I was, since 2016, I started doing blockchain, and then I got excited about the space. I felt that this is what I want to be the next 10 years. And then with some, former colleagues, we started thinking about the idea of why don't we, tokenize a venture capital fund, so you can then issue a token on the blockchain and provide liquidity to the LPs and automate all the payouts and all the management of this process rather than doing it in the traditional way, and thinking that this is also kind of digitizing the LP interest of a fund, but using blockchain technology rather than another approach. So we founded this venture capital firm called Spice VC. Is the first fully tokenized fund in the world that we have only issued tokens on the blockchain as the representation of your economic interest in the fund. It's obviously a security, so it was built and sold and managed as a security, which also led the creation of another company I have called Securitize, which basically specializes on issuing digital shares on the blockchain.
Can you explain to the LPs here in the room what the advantage is? Who are you cutting out by having it on the blockchain and by having them owning a token instead of,
In the financial world, there's two types of securities, let's say. There's private securities and public securities, okay? Private securities, the number one problem is the lack of liquidity, because they're private and by definition they're difficult to trade. They have complex agreements behind. They're difficult to automate. They don't have price discovery because no one knows how to price them, etc. So tokenizing those things on the blockchain and issuing digital representations of these private securities, whether the LP interest or equity in a fund or equity in a company, etc. Unleashes liquidity and automation on how you manage this in a way that is kind of like decentralized on the blockchain, immutable, transparent, auditable, etc. Public securities is a different story. So today, if you're a publicly traded company, and this is more of the startup environment, so most people don't realize about the problems, but if you're Facebook today, you list 3,500 shareholders, and Facebook is a $600 billion company. So obviously that's not true. There's not 3,500 shareholders, but maybe Nomura gets listed as a shareholder because they use what they call, in the financial world, it's called the street name, where you only list the broker of record, but you don't actually know who holds the shares. So this creates a ton of inefficiencies. So people don't know how to pay dividends. People don't know how to conduct proxy votes when they need to do, approve shareholders, changes or whatever. They also, securities don't sell automatically. So when you go and buy on E-Trade a security, let's say an Apple share, you actually don't own it. You just own the rights to someone that owns the rights to someone that owns the actual share, and it takes 2 days to actually do the actual settlement of the trade. And during those 2 days, anything can happen, right? The price can change, the company can go bust, can be acquired. So there's a lot of intermediaries, again, there that manage this is called counterparty risk. So the capital markets are extremely inefficient, both on the private side and on the public side. And blockchain is kind of a way to eliminate this inefficiency by building an infrastructure that allows people to, trade securities, whether they're private or public, and in a way that they don't have to trust each other, and that the settlement is automatic, right? So if I own a token that represents security in a wallet, and I send it to you, the moment the token moves from one wallet to another, and which is seconds, the security is transferred and it's instant settlement, and that's a huge improvement compared to the current market.
Okay, interesting. So at the end of the day, the LPs would still, if they would want to invest in a tokenized fund, would still receive a prospectus, would still go through the legal documentation, etc., but their ownership would be reflected via a token on the blockchain.
Correct. So you have to do an offering memorandum anyway, because you're selling a security. You have to sign a document, which you do it digitally, so there's no need to actually go there. And then instead of receiving a paper certificate, you just receive a token on a wallet that you've verified is yours, and that token represents the economic interest. So anything, payouts, transfer, etc. is coded there.
If Beko's fund would be listed, it would trade at a massive premium because of all the quality assets that it has in the portfolio, basically, for example, right?
Probably, and they'll provide liquidity to the LPs without having to wait for their underlying assets to be liquid. So next week, actually, our fund will be the first fund that will be traded on a security token exchange called Open Finance in Chicago. It will be the first time in the world that this happens, so we'll start understanding better how it works and what type of liquidity you can get, but there's a huge expectation.
So we are clearly at the very, very beginning
we
of
are
this.
at the very, very beginning.
Okay,
and crypto, I will say in general, we are at the very beginning. Even though Bitcoin is becoming 10 years old, the internet also was started like the main underlying protocols like the TCP/IP and things like that. They started in the 60s and 70s, right? And the internet didn't take off until end of the 90s. So I think we're kind of in the same situation.
To finish off on this thought process, because I think it's important for a lot of the LPs, where do you see it? See this kind of environment going in the next 10 years when you think about that? Do you think that all the KKRs and big private equity firms or even other venture capital firms, etc., all their funds will be on specific exchanges where everything will be tokenized and people will be able to switch from fund to fund as they see things? Is that the world you're envisioning? What's the world? How you, as someone that is really involved in this, how do you see it working, playing out?
I think that liquidity has a premium, right? So if your asset is liquid, you pay more. If your asset is illiquid, you have to depress the value to sell it because you don't find buyers, right? So I think that people that have very, very high premium assets, like or in the case of funds, let's say the Andreessen Horowitz, those guys will get away without offering liquidity and they will still receive investments. Anyone else, which is a second-tier fund, will not get away without providing liquidity if everyone else is providing liquidity. So as more funds get tokenized and there's more liquidity for this space, people will be forced to do it. Otherwise, the LPs will choose the one that has liquidity because it's very difficult to tell VCs apart, especially except for the 3 or 4 big ones. Everyone else has some good companies, some bad companies, some exits, some decent returns, but not radically different. So in this space, I think that tokenization and the liquidity will become. So
you see a completely new capital markets emerging on the fund side, basically.
Yes, because if you think about what has happened the last 20 years since the dot-com times, when the dot-com times, it was very easy to provide liquidity. I did an IPO, we raised $25 million in Nasdaq in Japan, more than 20 years ago. Today, it's impossible to do an IPO to raise $25 million. There's literally no market where you can actually IPO at that very early stage. The IPOs happen when you're a multi-billion-dollar company and you're going to raise $1 billion. So that's why in the past, you could invest in Amazon, in Apple, in Microsoft at the very beginning. And everyone, all the retail investors could actually benefit from it. Today, if you're, let's say, a retailer or a accredited investor, but not a professional or super qualified investor, you're completely out of where wealth is being created. Wealth is being created on the private markets. By the time Uber or Airbnb will go public, there'll be huge companies, right? So, and then, one way to get exposed to this will be through venture capital, but again, investing in venture capital is very difficult, right? You don't know how to do it, where to do it, where it is available, etc. So I think this way of fundraising also will democratize the access to the private markets, which is where wealth has been created, and they're completely out of the reach of most people.
Understood. Okay. Ben, I want to go back, instead of going more in detail about this. Generally speaking, and guys, obviously, feel free to be critical. Why do you think blockchains are useful? Or if you don't think they're useful, then say why you don't think they're useful. But where do you see the applications, basically? And is it more on the voting side? Is it really just financial services and moving wealth around? Is it on the digital gold hedging side? Where do you see the applications, and why do you think they're useful? If you think they're useful.
Yeah, I think this is, to us, sort of the core question that we're trying to wrap our heads around, which is what are the good use cases for blockchains? And to a first approximation, our view at the moment is that there really aren't very many. And a simple way that we used to sort of think about this is that basically you can think of a blockchain as a database, right? You could think of it as a market if that works better for you. But the database metaphor, I think, is useful. Most databases, when we think of them, they sort of live in some place that is centrally accessible and controlled by a single actor. And the innovation of a blockchain is to say, I can take a database, I can take the central trusted authority that controls this store of information, and I can fragment that out into various degrees of granularity. Bitcoin is fragmented out such that every single node, effectively every holder of it, in a proof of work construct is responsible for maintaining the full totality of the database. There are lots of other blockchains that have different models. Proof of stake is one, but you essentially have various permutations on the idea of who actually holds the keys to the database.
So just for, sorry for interrupting, just for some of our LPs to understand that in very simple layman's terms, you're basically saying there's a ledger on multiple 100,000 computers on the internet, and they all show the same information and they synchronize, and therefore that's basically the database that is not in one location, but it's in multiple locations, and therefore you know it's the truth. Because to change it, you need to change it on all different ledgers.
The Bitcoin chain basically works that way. I think the conceptual framework of who is the actor that controls the ledger, who controls the database, right? And most of us are used to thinking of, well, I control my database, or the company controls the Oracle database, or whatever it is. But on a blockchain, there's some other set of people that hold it. And this is the idea, the word that the community uses is called trustless, in the sense that you don't have to trust a single actor, you can trust a fragmented confederation of actors. And the question really at the end of the day is, where is this useful? Like most of the time, there's a tremendous amount of value in having a centrally trusted actor. And actually, I would argue that most of the use cases that you're describing, Carlos, we want centrally trusted actors, right? Like the illiquid LP interests in a fund as opposed to a token, I can't steal it. It's useful to have a centrally trusted actor who can reverse the trade if it goes badly. And this is part of the problem with any number of exchanges. If you prefer the markets metaphor, a good example is if you trade stocks, you can certainly trade stocks that aren't listed on an exchange, but there's risk in doing that. You might be defrauded. You might be buying a security, if it's not regulated by the state, that actually isn't the thing you say it is. And so there's a reason we have chains of title and regulated markets, cleared markets. Blockchain is in some sense an uncleared market. And there's a reason that we tend to like these things. There's a cost to it for sure. And that cost is admittedly very, very inefficient in the existing financial services architecture.
You don't need to, none of the things you said disappear with the blockchain, right? So there's still, a regulatory rule that determines where the trade happens. There is still a proof of ownership that the token represents whatever asset represents. It happens in a trustless way, as you said at the beginning, without having to have these intermediaries, but guaranteeing that it happens. Security tokens are not like Bitcoin. You can reverse a trade if you need to, but there's also a decentralized process for determining
You can have these kinds of things for sure, although the existing track record of blockchains is not that way, right? And that, in fact, when virtually everything that's happened on an Ethereum blockchain in terms of smart contracts, inception to date, has either been hacked or stolen, or there's things that have been lost, right? And so it's totally possible that on blockchains we will end up replicating a lot of the existing kind of rules and have sort of actors that are capable of reversing trades. But there's actually some real technical problems. If you truly have a decentralized, trustless thing, how do you reverse a transaction? It turns out it's surprisingly difficult. Like if on a Bitcoin blockchain I send money to somebody, and it turns out that I pressed the button and I sent them the money, but they didn't then follow up and send me back the thing they're supposed to do, I can't get that money back. If I send a wire through a bank, I actually can if there's fraud, because the state steps in and says, no, that was fraud. We send the money back. And they can't do that on a blockchain. So to answer the question, we struggle to figure out where you want a truly trustless blockchain, because most of the time central actors turn out to be pretty valuable. The best use case that we come up with is actually that Jez has articulated, which is a form of digital gold. Because there you really don't want a centralized actor.
Correct.
Like the reason in the Great Depression they made it illegal in the United States to actually possess gold is because they really needed people to use greenbacks, to use dollars, and people weren't, because the dollars turned out to not be worth anything in that moment.
Just for the ones that don't know this, so right after the Great Depression in the 1930s, I believe it was 1936 exactly, around April if I'm not wrong, the US government came up with a law and said that anyone who trades, owns, possesses, or is involved in physical gold has to give that gold back to the nearest government-owned bank branch. And if he doesn't do so, there's up to 6 years of prison terms, basically. That's how the US government back then shored up its gold reserves, and then basically showed the world that its currency is strong, because it was showing all these gold reserves backing, because we were based on a gold standard, showing how strong its currency is, because it had all these gold
They were in a
reserves.
massive disinflationary spiral because people just stopped using the currency, and so they needed to get people to use it.
Correct. So
to
if you
reinflate the economy.
if you think of these terms, and quite funnily actually, again for the ones who don't know, Ray Dalio explains this really, really well. In the whole century of the last century, you only had 2 periods where the interest rates went to zero, which is called the zero bound. And it was actually in 1930 and now in 2008, basically, right? So, or 2009. So we've gone through a once in a century or two in a century event, and we know exactly what happened after that in the first Great Depression in the 1930s. That's why Satoshi Nakamoto, this unknown individual, basically came out with this protocol and unleashed this, which then found people that are interested on it, because as Ben just mentioned, it actually, at a minimum, it gives you that use case of ownership. It's your digital gold, and it's immutable, and nobody can take it away from you. And you can actually travel with it through borders, so to say, right? So, and that actually brings me to the next question. Having established that it's difficult to find these wide applications on blockchain, and actually the most simple and clear use case is the whole digital gold aspect. Why should these institutions care? Why should our LPs and others, why should they care, Jez? Can you explain of how Nomura is looking at this?
Yeah, I think just I'll go back a little bit. I mean, I stand not too different to your view that being an institution, I've looked at heavily as well, where the complete decentralization is going to work. It is today very few applications you can find from a financial institution point of view and from a governmental point of view, because they won't control ultimately, right? Once they lose control, obviously it just kind of becomes taxation, becomes it. So they love control. So to work with them, certain applications have been very powerful. I'm a big believer of tokenization of assets. Certain assets are getting tokenized, fixed income, like you mentioned, certain aspect of it, opening up to the wider community. Mortgage market is looking to get tokenized, but within that tokenization, they want central nodes.
Correct.
And this tends to be active.
That misses the point of using a blockchain. Then
but I'm saying,
if you're going to have a centralized Oracle database and
correct. So, but the whole idea is that today a lot of the application tends to be around the efficiency it provides, right? Like let's say payment, be it settlement projects are being worked at the financial institutions today, utility coins for settlement, because it's a big drag on the system, right? If you want to do a derivative contracts, you got to go to DTC. Settlement, it's a day, a few days process, right? So that efficiency everyone's going after. And as you say now, coming back to digital gold, I mean, it's a true, many people are looking at it because it's a potential hedge. I mean, like you said, many people are realizing we are coming close to the QE. By end of the year, ECB is pulling out QE, already US is hiking rates. So we're probably third, fourth innings in our investment cycle, right? This is not the time to really, go crazy in investments, really, if you look at it, because, it's very recent comment by Druckenmiller as well. We tend to agree probably this is the time to pare down on some investments or wait, because the opportunities will come. And during that time of uncertainties where some of these hedges could work. Interestingly, despite the fact that we've gone through a very lull or tough period for digital assets, we've seen the huge amount of interest in by the institutions. By far the most. Over the last 6 months, if you look at it, it's not the ICOs. ICOs quite a lot of have been, fraud or close to fraud. But institutions, if you look at it, over the last 6 months, you've seen significant amount going into digital asset projects. They're going to invest in exchanges. They're going, truly institutional exchanges. The ICE launched the exchange. So there's a lot of work. It's a kind of still evolving market. I tend to agree with Ben that we are at probably a tipping point. It may take 1, 2, 3 years, and with Carlos as well, that to really start seeing the proper adoption.
There's tremendous demand to trade this stuff.
I just want to say something in terms of thinking about what a blockchain is. Instead of like technical definitions, it's a decentralized database with a ledger. I think it's simpler to think of, is a way to eliminate an intermediary that its own value add is to transfer, is to guarantee value transfer, any type of value transfer. So it's not surprising then that, VCs or financial institutions, they say, well, but, centralized is better because we control, we provide guarantee. The point is that you can actually eliminate.
Carlos, we need to explain to the crowd again, I'm wary of the crowd, we need to explain to this, for them to understand it, we need to explain the double spend problem.
Yeah.
So, and how Satoshi's white paper is solving the double spend problem.
It's very easy to understand.
I'm just going to give people a very simple example. If I have the Mona Lisa sitting in my living room, I wish, I guess, And I make a picture of that, and I send it to Danny, which most of you know, and I say, Danny, look, I love you so much. I've just sent you the picture of the Mona Lisa and promise you I've only sent it to you. Danny will say, come on, man, like this is a picture on your phone. You might have sent it to 100 other people. How do I know that this is the only picture around of the Mona Lisa basically hanging there? He will not know because there is no way for him to make sure that I didn't double spend that picture, if you know what I mean, right? If I have sent it to someone else, then, it's not unique anymore. That's what Satoshi basically solved in the white paper. Given that every transaction immediately gets reflected on all the different ledgers globally, and given they are synchronizing, everyone knows that I've sent the one picture of Mona Lisa at that time, at that moment, from my address to his address. And that means I can't do the same transaction again. So he's actually found a way for the first time to transfer value on the internet without being able to double spend that value again. So if I send $10, I can't take the same $10 and spend it again. So he's solved the double spend problem that we had at the moment, right? You can send the same email 100 times to other people.
It's easy to think
You can't
about
do that.
digital cash, right? So if I give you, 10 dirhams, the moment the node leaves my hands and gets to your hands, it's done, right? So you've taken the money, I don't have the money. If you digitize this money transfer process, until Bitcoin, you needed a central institution like a bank or multiple banks to basically make sure that the money actually gets transferred. It doesn't get recorded in the destination and then it's still recorded on the origin, which is the double the spend. But the same philosophy can be applied to any other type of value transfer. And of course, the degree of decentralization you need, depending on the regulation, et cetera, is varies. It might not be 100% decentralized, translate immutable, et cetera, like a big Bitcoin blockchain, which I think is one stream of usage. But there is a lot of opportunities to eliminate intermediaries. So for people to understand when a blockchain might be a solution versus when it might not, the answer is as simple as that. Is there an intermediary that the only reason for them to exist is to guarantee that value gets transferred? And if you guarantee that value transfer without an intermediary, then a blockchain might be the solution to eliminate that intermediary. As simple as that. Yeah. Now, that doesn't mean that you can actually do it today, because technology, as you said, is very immature. So we are kind of like in 1994 when it took 10 minutes to connect to the internet with a dial-up phone, and it was all pixelated, and the only thing you could get was get the football scores, and that's it. So it's still early days.
Having said that, I think it's also important for people to know that an idea that started in 2009, basically, which was nothing more, it was Bitcoin. The white paper was just an idea, basically that was unleashed then, is now 10 years old, and within the 10 years, you never had any downtime, right? You never had any time where it, over the 24 hours that it works, 365 days a year, that it didn't work. That for some reason, the nodes didn't synchronize, etc. You never had that issue.
Look, there's hundreds of billions of value in blockchains today. I mean, and I think to be clear, that's why institutions want to trade this stuff.
Correct.
Right? Is that in a similar way to the value of gold, which is something that we sort of collectively have decided holds value, and therefore people hoard it and trade it. At the moment, the state of the world is basically that we've collectively decided that Bitcoin and Ethereum and other sorts of digital assets hold some value, and people want to exchange that value and trade it. And there's real demand for institutions to do that, and I think we have an investment in a crypto platform for institutions out of our fund. So to be clear, I think we all agree that there's tremendous potential uses for this and that people will trade it. I think where it gets tricky is, are institutions going to use tokens and digital currencies for a whole set of potential use cases beyond trading them?
Yeah.
And does it grow beyond something that looks more like gold into security tokens and all the other kinds of things that are out there?
For example, again, to connect with the previous panel, I had read that the Moscow municipality was using the blockchain to basically ask people to log their improvements that they require for Moscow city, where they want another road, where they want to have a bus route, where they want to have changes being done in the infrastructure. And those things get then on the blockchain basically noted, and things get improved. I guess the question you're asking, Ben, is that's all nice and fine, but is there money to be made on this, basically?
Well, does the Moscow government need to use a blockchain to that? Because it
Right.
just
That's
use a
the other
database.
thing.
And that's sort of the point.
It's not the case of where you eliminate an intermediary.
And there's no question there's a lot of applications, like KYC, AML is a very good thing. Obviously, blockchain has been a huge beneficiary. I mean, the KYC, AML process benefit from it massively. I personally think for institutional adoption, it's happening. We are at a tipping point. It'll take years. Three key things, which is the issue the crypto or blockchain as a whole is going through. Some are more so crypto is that you need to have idea of custody, which is one of the problems we are attacking. Because without that, guess what? All this stealing, you can steal billions of dollars within a fraction of a second. Right?
There's a lot of startups, by the way,
yeah.
in San Francisco that
So-
have like a couple hundred
Yeah,
million of crypto
that's
on a
right.
server
Yeah.
that sits in an office building that
Yeah.
has borderline no security, and there's like 8 nerds sitting around laptops.
Yeah.
And so
So-
you're going to see
So
like people with
that's right.
guns take
That's
this
right,
stuff
that's
over
right.
the next
so
5
custody
years.
is a huge thing. The second biggest thing I think for institution and greater adoption is the provenance of these coins or basically understanding it. The biggest issue anybody has is you get a coin as an institution, right? Suddenly this has gone from North Korea, few transactions ended up at you. When the governments come and ask, where is it got to? You know, as an individual, you don't have accountability. But if you are asking a pension fund to invest, they have to be accountable. So it's not just a KYC anymore. You need to have KYT, knowing your transaction, where it came from. So which is why some of the companies are gone.
Isn't it that better than cash, which is what people use today? So,
Sorry?
because at least on the blockchain, you can actually trace.
Yeah,
everything.
but traceability also brings its own headache, right? So you need to then go and do that work. So there's not many companies are doing it. So of course you need to bring. And the last is regulation. Without regulation, it's very difficult. Because how many of these ICOs have gone bust? The people are just going, retailers are going to invest, they've lost money. There's a lot, right? I mean, the entire asset price inflation, we went to 800 billion, the entire crypto. Now it's close to... so.
Unfortunately, we're out of time. Thank you so much, guys. I really, really enjoyed this conversation. This was very helpful for me. I hope it was an eye-opener a bit, and at least something for the LPs and members here that are participating in terms of, something they at least need to think about. Okay, so thank you very much. Thank you.